You know what the best feeling in the world is? Saving someone money, right? I was rushed to get on live because I was on the phone with an agent close to 9 p.m. right now, trying to explain to him why in escrow the consumer wants to change, saving them $6,000. What's going on, guys? My name is Minh with What's a Mortgage. Welcome to our channel. The goal of our channel is to educate, empower, and to connect you with the right mortgage. If it's your first time tuning in, welcome to What's a Mortgage. Hit the notification and subscribe button if you want to join the WHAM fam. And if I were you, I would definitely want to join. Saving someone $6,000. It could be you too, right? And of course, as part of the WHAM fam, I'm always here to answer all your questions. Remember, this is an interactive channel, so let's interact. If you got questions, if you feel so uncertain about home ownership, right? Tonight's the night to ask. And if you don't ask tonight, you can always call or message us. All right, guys? Tonight, we are going to go over the rules about income, part 2. Everything you need to know about income and how to qualify for home ownership. This is our second part. If you haven't seen our first part, definitely go to our Facebook, go to our YouTube channel, and watch part 1, right? It's everything you need to know about income to qualify. We talked about the different types of income that lenders use to qualify you for home ownership, right? We talked about fixed income. We talked about rental income. We talked about self-employed income, and we talked about being a wage earner, right? If you're trying to qualify for a home, you have to follow under one of the 4 categories, which you should, because there's only 4 categories someone would fall under for home ownership. Tonight, we are going to break down the rules of each type of income, okay? So once you understand the rules now, then you can run the numbers. Some of you guys watch me on Instagram. If you haven't followed me on Instagram, definitely check out our Instagram, right? I talk about running the numbers all the time. What does it mean by running the numbers? When I say run the numbers, it means you want to see what the mortgage payment is. You want to run the number on your income and see what you qualify for, right? So when I say run the numbers, you would run the payment, you would run your income. You want to run the numbers so you can run your life. Run the numbers so you can make the best decision for you and your family. And tonight, I'm going to show you how to run the numbers for your income, all right? So let's get into the rules about your income. So anything in life, any business, any occupation, anything that you do has specific rules, right? And in qualifying for home ownership, each category has its own rule. So let's talk about fixed income first, right? So if you are buying a home and you are using fixed income to qualify for home ownership, right? You're either going to have taxable or non-taxable income. If it's taxable, of course, you're going to use the gross income of the taxable income to qualify for home ownership. But majority of income that people use to qualify for home ownership is non-taxable. Okay, so we want to focus on non-taxable income. Taxable, pretty self-explanatory. You go off the gross income. When it's non-taxable, and remember, it has to be either government ordered or court ordered, right? So if today your friend decides, I'm going to give you $1,000 a month for 5 years, guess what? You cannot use that income. It must be court ordered or it has to be government ordered. Once it's ordered and it's non-taxable, now you can decide to gross it up. Lenders gross it up because they're assuming what your potential income can be if it was a taxable income, right? So when they're grossing it up, there's 2 numbers you want to look at, but also remember, on FHA loan, it grosses to 115%. And on VA, USDA, and conventional loan, you can gross it up to 125%. For example, if you were going with an FHA loan and you were making $2,000 a month on your non-taxable fixed income, your gross income would be $2,300 a month. That will help you qualify for more house, right? If you're going with a VA, USDA, or a conventional loan, you can gross it up to 125%. So if you're buying a home, right, and your income is $2,000 a month, you can gross it up to $2,500 a month, okay? So if it's non-taxable, you can gross it up. But remember this on non-taxable income or all fixed income. You have to be able to prove that you're receiving the money. What do I mean by that? Let's say Social Security, what they're going to ask for is they're going to ask for your 2 month bank statements to see that you're receiving the money before they allow you to use it, right? As long as you receive the money, then you can use the income, especially with child support, alimony, right? If the child support or alimony court ordained letter says that you're going to receive $3,000 a month, right? Before you decide to gross it up, what you want to do is look at the last 2 months of your bank statements. You want to make sure you are receiving the money. If you are receiving the money, now you can gross it up. When I say receive the money, receive the actual dollar amount on the ordained letter. For example, if they say you're receiving $3,000, but you're receiving $2,000, even though it might be court ordained, they're only gonna let you use $2,000 a month, and you can gross it up. But check this out: if it's court ordained and they say you're gonna receive $3,000, but you get $5,000 for some reason, right? You can only use the $3,000. They're using worst case scenario. So remember the rules on fixed income, right? Is it taxable or non-taxable? If it's non-taxable, we can gross it up. But before you decide to gross it up, you want to look at the reward letter or the court ordained letter to see what it says. Then you want to look on your last 2 months of your bank statements to show that you're receiving the money and it matches the letter, right? The reward letter or ordained letter. And if it doesn't, and if it's more that you're receiving, you only can use what's on the ordained letter. If it's less than what you're receiving from the ordained letter, you can use the lesser amount. Okay, so that is the first rule when you're trying to qualify for home ownership with fixed income. Hopefully that makes sense to you. You can call us, message us if you have fixed income and you feel uncertain on what to use or if you can use it or not. You can always reach out to us. Okay, so now let's talk about the second type of income: rental income. Okay, so here's rental income for those of you who are vacating a property to buy another property, those of you who are buying a new rental property, or those of you who already have rental property. Okay, so remember, with rental income, there's two types of rental income. There's existing rental income and there's future rental income. Remember, on existing rental income, they're going to go off your tax returns. So of course, they're going to look at your gross amount. They're going to subtract the cost that you spend on your rental property, right? And they're going to allow you to, whatever's net, that you can add back depreciation into your rental income to give you more income. They're going to take a 2-year average. If you do have an expense 1 year of something you have to fix to maintain the property, if it's only a one-time thing, guess what? They're not going to hit you with it as long as they can see in the other year, your newer year, you might not have had that cost. Or in your older year, you didn't have that cost. For example, if you have a rental property, you had to change the air conditioning, right? And that cost you, let's say, $4,000 to fix, right? If you don't have it in both years, they're not going to hit it against you. So before you decide to go to your tax person and write off everything, if you're thinking about either refinancing or buying another property, you might want to take a step back, look at your tax return, set yourself up for success. Do not write off everything. They're going to take your gross, subtract all your costs and your mortgage payment, right? But they're going to add back depreciation and give you that as your income. They're going to take a 24-month average. That's existing income. That's for buying. That's for your current properties that you own, okay? If you're buying a new property, if you already have those properties and that's existing, if you're buying a new property, you're going to follow the future rental income rule, okay? So for the future rental income rule, if you're buying a new rental or you're vacating a property to buy owner occupied, your current property is going to be rental income. So for future rental income, they will let you use up to 75% of the gross income. What do I mean by that? If your gross income was $4,000, they will let you use up to $3,000. Why did I say up to 75%? So there's another rule, right? There's rules all the time, right? Life is about rules. So if you are, so there's future rental income rule. So there's existing landlord, which means you've been a landlord for over 2 years. That means you have proof that you're receiving rent for over 2 years. You're an existing landlord. If you're a new landlord, which means pretty much you're vacating a property to get the next one, or you haven't owned a property, rental property for more than 2 years, you are a new landlord. If you're a new landlord, you can use up to 75%, right? What does that mean? So if you were collecting $4,000 a month for rent, you can use up to $3,000. If the mortgage payment is $2,500, you can only use the $2,500. You can't use that additional $500 a month if you are a new landlord, right, on future income. But if you are not a new landlord and you have history of being a landlord before, you can use the full 75%. So if the rent is 4,000, you can use 3,000. Okay, so remember that when you are using rental income on existing, they're going to take a 2-year history. Make sure you don't write off everything. On future, up to 75%. If you're a new landlord, right, up to 75%. If you're an existing landlord, the full 75%. Here are some tips that I see people run into all the time, the little pothole or the little mistakes people make, right? So people have this great idea. Ooh, I'm going to buy my new house. Mortgage hack or real estate hack. I see them all over the internet. They don't work. These hacks, they're just bait and switch, or they're just clickbait. What do I mean by that? Oh, you can use 3.5% down to buy FHA, and then you can house hack it and go 3.5% down FHA over and over again. Or you buy a home, FHA, you convert it to conventional, and you buy another home, FHA. Well, here's how the hack fails. FHA has a 100-mile rule, right? I've watched videos from other loan officers. I'm not going to say their name. They're teaching this, and they're teaching these house hacks. But you cannot, if you own a property and you buy another property, FHA, 3.5% down, you cannot use the future rental or vacating rent if that new property is within 100 miles of your current property, right? So a lot of times people try to use that vacating rent. You can do it on conventional, you can do it on VA, but you can't do it on FHA. So if you own a property, right, doesn't matter FHA or conventional. If your new property is FHA, right, you can't use vacating rent, which sometimes a lot of people don't qualify with their current mortgage payment that they're vacating and their new mortgage payment. So that hack doesn't work. What you do is you have to either go VA, right? But if you go VA, you got to take the other one, convert it to a regular loan so you can use your VA again, right? Yes, you can have 2 VAs, but it is very rare to see someone with 2 VA loans. It's like a unicorn, all right? So you would take a VA, convert your loan into conventional, then go VA. But if you have an FHA, if you do want to do the 100-mile, if the property is within 100 miles and you need that rental income, you got to go conventional, okay? I see that people try to do that all the time. I say that's probably the most common FHA or loan officer, or I call it JV loan officer mistake right there. Okay, so make sure you remember that 100-mile rule. Here's another rule for FHA for rental. Okay, there's something called the self-sufficient rule. I see people talk about house hacks all the time, right? So there's something called the self-sufficient rule. If you buy a home with FHA units, which everyone wants to go units, the reason why, if you go conventional, you go into a duplex, you got to, even if it's owner occupied, you got to put 15% down. 15. If you go with a triplex or fourplex and you're going to live in one of them, right? You think you're going to go with a owner occupied down payment of 3 or 5%? Wrong. You got to put 25% down on a triplex or fourplex. So everybody charges for, let me go FHA, right? Everybody wants to go FHA because it doesn't matter if it's a single family home, a condo, a duplex, triplex, or fourplex, it's 3.5% down. But the rule of thumb is the rent of all 75% of all the rents added up together has to be more than the mortgage payment. If it's not, you cannot use rental, you cannot buy those units. So, right, that's for only triplex and fourplex. If you buy a single family home, right, you're okay because there's no self-sufficient rule, right? If you buy a duplex, they don't hit you with this self-sufficient rule. They only hit you with this self-sufficient rule on triplex and fourplex. So if you buy a triplex and fourplex in California, in either Orange County or LA County, most likely it won't pass the self-sufficient rule. If you get out in Riverside, you might come close. San Bernardino, you have a better chance. But if you buy in Central California, Kern County, right, somewhere around there, if you buy outside California, I see the house hacks working, right? These, you can buy a 4-unit, 3.5% down FHA, right? Live in it for a year, rent out the other units. Once you have enough equity, convert it to a conventional loan, right? You would need, to go investment, you probably would need 25% equity. You can convert it, buy the next one FHA again, and then repeat every time you have enough equity, right? So the house hack only works if the self-sufficient rule doesn't hit you, okay? Last but not least, with rental income. I made this mistake once, and I won't make it again. If you buy units VA, I told this borrower one time, I can't qualify you because if you're buying units and veteran VA, right? You need a 2-year or 1-year history. You've been a landlord. If you don't have that 1-year history, they can't use rental income to help you qualify. I was wrong, right? Some people got to admit it was wrong. It was a long time ago, many moons ago, right? But if you go VA and you don't have landlord experience and you want to buy units and use rental income, the up to 75%, right? As long as you use a property management company, then you can use future rental on units on VA to qualify for home ownership, right? So that works on VA. Those are the couple hacks. The reason why I bring up the 100-mile rule happens all the time. Everyone tries to go, oh, I watch this guy on YouTube, right? And he's telling me I can do this house hack where I can keep buying FHA. And as long as you can qualify both payments on the 100-mile rule, right? Or I'm going to buy these units. I'm going to build this empire. FHA 3.5% now. Wrong, right? Remember, self-sufficient rule. And last but not least, VA. I see a lot of people, their hearts, their dreams crash when their lender tells them we can't use future rental to help you qualify. But you can as long as you use a property management company. All right? So we talked about the rules of fixed income. We talked about the rules of rental income. Let's talk about self-employed. If you are trying to buy in 2021 self-employed, make sure you have your tax person prepare a draft tax return. Before you write off everything in the sink, right? You want your lender to see your tax returns. They're going to go off of a 2-year average, okay? So before you claim all your deductions, they're going to take a 2-year average of your net income. But remember, they're going to add back depletion, depreciation, and on Schedule C for sole proprietary, you can add back business miles, okay? So remember that. They want a 2-year history of your tax returns. So I know a lot of you guys were wage earners because of the the pandemic. A lot of you guys had to become self-employed. If all of a sudden now you hit the jackpot and you're making more money self-employed, you got to wait 2 years to use your tax returns to buy as a self-employed person. But if you were self-employed and you became a wage earner, you can buy after 30 days. Why is that? Because W-2 income is more consistent. They don't depend on someone driving in the business, right? As long as you're a wage earner, you can go from self-employed to W-2, you only have to wait 30 days. You can only use your base income. But if you go from wage earner to self-employed, you got to wait 2 años, aka 2 years. Working on my Espanol, all right, guys? Remember, also, if you're self-employed, if you are, right, I said 2-year tax returns. That's for FHA, VA, USDA, and conventional. But conventional has a quirky rule. If you are going conventional and you're putting 5% down or more, so it won't work on 3% down, 5% down or more, they will go off of your 1-year tax return. So let's say you wrote off everything in the sink, right? You can redeem yourself in 2020, right? In 2021, you can file a tax return. Do not write off everything. Well, I might owe. Just add that monthly payment, what you owe, to your debt to income ratio. But they will go off of 1-year self-employed tax returns. If you've been self-employed for 5 years or longer, or your business has been around for 5 years or longer. What's the difference? That same business can be 5 years old or longer, but you're self-employed and you keep changing your entities when you're self-employed. As long as you've been self-employed for 5 years, you get a letter from your CPA, then your money, right? Then you can go 1 year self-employed on conventional only, right? So 1 year, you're going to have to pay some taxes, fam. You can either avoid the IRS or pay or avoid interest rates, right? You avoid interest rates, then you can't avoid the IRS, right? One or the other, okay? Also with self-employed, because of the vid, but these rules I feel are going to be permanent, is they're going to check your deposits, right? Someone asked me one time, well, if I'm on unemployment, if I'm collecting unemployment on self-employed, can I still qualify? If they look at your deposits and they don't see that you're getting regular deposits and they just see that unemployment deposit, guess what? You're not going to qualify. So make sure you have healthy deposits. Depending on where you buy this house, if you buy it and during this pandemic, right, they're going to ask for all your bank statements for the last 12 months to make sure that you're getting deposits, right? If you are watching this video and the pandemic has passed, right, 2020, 2021 has passed, They might still ask for either 2 months or 6 months bank statements to make sure you have deposits. They want to make sure they're real deposits. They're not looking for bank transfers. So if you transfer from one account to the next account, they're going to want to see that account now, right? They want to see real deposits to make sure you are really in business, okay? Also, they're going to check your P&L, your profit and loss. They're going to ask your CPA or tax person to prepare a P&L so they can see this person is still making money, right? They want to make sure this business is still in business. So that's the rules on self-employed. You have a lot of wiggle room, but you got to make sure you structure everything correctly. That's why I highly recommend, if you're self-employed, you really talk to a lender to create a game plan before you file, right? You might not be able to write off everything so you can qualify. You pick what's more important, getting the house or saving that money. Remember, you can always set up payments, all right? Remember that. So that right there is self-employed income. So we've gone over fixed income. We've gone over rental income. We've gone over self-employed income. Let's talk about the W-2, right? With W-2, I'm doing it a little bit differently, right? These rules. I'm going to talk about some rules that are commonly mistaken, okay? So if you're a wage earner, W-2, they want to make sure you have a 2-year history that you are W-2, right? And they're going to make sure, right, that you have income, right? But here are the rules. Remember, like I said, you can go from self-employed to W-2. If you were self-employed for the past 10 years, you wrote off everything in the sink, but today you became a wage earner, right? And it's a legitimate company, of course, right? It's not your cousin trying to pay you to put you on W-2, right? You go with a legitimate company, put you on W-2. As long as you've been on W-2 for 1 month, right, they will let you qualify for home ownership. But remember, you're only able to use the base income, right? So that's rule number one. That's, rule number one that I feel like everyone mistaken. You do not need to be at the same job for 2 years, okay? Well, let's talk about the second rule, right? The second rule is the history of overtime or bonus. If your old job has a 2-year history, your job has 2-year history of overtime or bonus, you can use the income, okay? But if your old job has overtime or bonus and your new job doesn't, right? Then of course your new job, if you don't have overtime or bonus, you can't use what you don't have anymore. But let's say your new job has overtime or bonus, but your old job didn't, you cannot use overtime or bonus unless you have a 2-year history with your new job, right? I see this happen all the time. Someone changes jobs, right? They took less pay when they transitioned because their overtime or bonus or the commission outweighs what they made at their last job. But their last job, they didn't have overtime or bonus. So now they're in a predicament. Even though they make more, they have to wait the 2 years because they don't have the 2-year history. So if you're transitioning job, you want to ask yourself, on my old job, did I just work salary, right, and hourly? Cool. If I do, on my new job, they can use my higher base, right? And I'm good to go after 30 days, right? But, okay, I took less pay, but I'm going to make it up in overtime or bonus. You're going to have to wait 2 years, all right? You have to have a 2-year history, okay? Hopefully that helps out. And the rule now, right, another rule that gets mistaken, right, is the part-time and seasonal job. If you have a part-time or seasonal job, you can use it to qualify for home ownership. I see people all the time, I can't buy because it's seasonal or it's part-time. As long as you have a 2-year history, right, and they can call and validate that you still work there, right, especially for seasonal, they will take a 2-year average. Like, for example, if you work for Mountain High, right, out in California, right, you work there during the holidays every year, right, you have a 2-year history. Let's say you want to buy in July, but you're not working at Mountain High. They're going to call and validate your income. As long as your VOE checks out, you can use your second job or your seasonal job, okay? So if you have 2 jobs, right, I hear this happen all the time. Well, man, I just got another job. I started doing DoorDash. I started doing Uber, right? If you're doing DoorDash or Uber, you have a full-time job, you need a 2-year history. So as long as you have 2 jobs for 2 years, then you can use that income to qualify. Guys, if you have income questions, bring it all on. I'm not avoiding you. I'm not dodging you. I'm going to get through these slides. I'm going to answer everybody's question. Hopefully this information is helpful. If it is, do me a favor, hit the like and share button, all right? Get back to it. So if you have your job for two jobs for 2 years, you can use that income to qualify, okay? Another one, people mistaken, college degree. If you have a college degree or you went to a technical school, right, for a specific degree, being a nurse or a truck driver, right, you don't need a 2-year history. Your diploma or your transcript, right, is suffice for making up your years of work. Let's say you worked in the nursing program, or you worked in some iron worker, craft, right? You have your degree, you have your transcripts, right? You have your internships, right? You're doing hair, you have all that information. You can use that income after 30 days. You don't need a 2-year history, right? So remember, if you have a degree, college degree, or you had your transcript from a technical school, right? A school that has a specific job that you go to school there for, right? You go to school to get a specific job, that makes up your 2 years. So now you can buy. Here's another rule, right? If you have a gap in employment, if it's not COVID related, right, they allow up to a 6-month gap. That means you can buy a home as long as you get a job within 6 months. If you get a job after 6 months, you have to wait 1 year before you can use your income to qualify for home ownership. Okay? Now there's a COVID rule. If you have COVID, or not if you had COVID, but if you are unemployed or you got let go of your job because of COVID, right? If they allow up to a 12-month gap. That's all lender, right? Every lender has their own interpretation. Definitely reach out to your lender. Hey, is it a 12-month gap or 6-month gap, right? Hey, I got laid off or I had to change jobs because of COVID, and it took me a year. But here is 30. For me, they probably will go off of not 30 days worth of income. They probably want 60, 90 days worth of income, but they're not going to make you wait a year if you got transitioned out of your job because of COVID, okay? Last but not least, the new rule that came out because of COVID, right? If you are at a job and you've been there, you're a ride or dyer, right? You were there for 20 years. You got a pay increase. Before they would let you use it in a drop of a dime, right? Because you have a letter, you've been in a company for years, right? Now they want you to receive your new salary or base income for at least 30 days. Once 30 days, now they will use that new base income with your raise to qualify you for home ownership. All right. So those are the common rules. If there's a specific rule that I did not talk about tonight, definitely bring it up. Before we go to Q&A, let's recap. So tonight we talked about fixed income, right? We talked about taxable, non-taxable, grossing up between 115 or 125%. And make sure we have that proof, right? The proof, and make sure we're actually receiving that money. That's fixed income. Let's talk about rental income. We talked about existing, right? They're going to go off your tax returns, right? So make sure you don't write off everything for existing rental properties. For future, remember, you can gross it up to 75%, depending if you've been a landlord for 2 years or more or not. If not, you only can gross it up to 75%, no more than the mortgage payment, right? But if you've been a landlord for 2 years, you can go the full 75%. Remember the FHA's 100-mile rule, the self-sufficient rule, and VA's rule on the property management company, okay? Self-employed income, remember, 2-year tax returns, right? Depletion, depreciation, business miles, add all that back. Conventional, 1 year self-employed, remember that, right? As long as you've been self-employed 5 years or the business has been around for 5 years or more. And remember, guys, your self-employed, keep up on those deposits. Avoid those transfers. No bank transfers, right? They want to see them deposits, right? And an audited, some of them want an audited P&L or just a P&L, okay? Last but not least, we went over wage earner, right? We went over self-employed W-2, you're solid, right? We went over overtime and bonus, you need 2 years. We went over 2 jobs or seasonal job or part-time job, 2 years. College degree, you don't got to wait 2 years. You need, proof of your degree, proof of your transcripts, and been at work for 1 year, right? Been at your work for 1 month, right? We talked about the 6-month gap. As long as you start working as a wage earner again within 6 months, after 1 month, you're good to go, right? You don't have to wait a full year. But if you got laid off because of COVID or changed job because of COVID, right, they allow up to a 1 year gap. And last but not least, right, if you got a pay increase, the 30 days worth of pay. So hopefully, with all this information now, you are able to give yourself certainty in knowing that you can buy. Don't wait, don't hesitate, participate because you know the rules of income to qualify for home ownership. Let's get into some Q&A here. If you enjoyed the information, do me a huge favor. Hit the subscribe button. And also share and like this video. If you are buying a house or you think about refinancing, right? And the person who is buying or refinance is not sitting there with you, do me a favor. Tag them on this video. All right, guys? Let's get into this here. BB, my job slowed down at the beginning of the pandemic. I claimed unemployment, but was still working part-time. Well, I have to wait 6 months. No, you do not have to. As long as you're at the job, if you're working part-time, they're going to average out your income, right? If you went back to full-time, 40 hours a week, as long as you've been back for 30 days, they can use your full-time income. If you're still part-time, right, they're going to average it out. Hopefully that helps you out there. Okay, Genevieve has a great question. Oh, I have a quick question. If you worked under the table for a year and a half ago, but it was under the table and not taxed, but the employer will vouch, can that be used as part-time for 2 years? No. What I would do, Genevieve, I would just file those 2 years, right? If they paid you under the table, file them on your tax returns. Go back and file your 19. Go back and file your 18, all right? If you file them, you can still qualify. But if you don't, you cannot, all right? Hopefully that helps you out there. Okay, guys? Hopefully tonight you enjoyed our live stream. Like I said, I appreciate everybody who's been watching, who liked and shared. And remember, every Tuesday on Instagram, if you're not following me on Instagram, definitely do it. We do Q&As all day, right? So anyone can ask me any mortgage question on Tuesday, and I will answer it. And I do my best to answer it in 15 seconds, right? So I can get the next one and the next one. So that's Tuesday. And on Friday, it's loan estimate challenge, okay? So if you have a loan estimate, I'm going to do my best to beat it or find one of my affiliates that can beat it. We've lost one last week, right? We lost a builder lender. Most likely we won't beat the builder lender because the builder has already factored in the closing costs in your purchase price, right? So we can't really beat that. So, but we beat a lot of the loan estimates. Like I said, I barely made it on time tonight because I had a consumer on Instagram, right? It was part of the Tuesday challenge, but it rolled over to Wednesday, right? They're in escrow. They're buying a house for $315. What's up, Juan? How you doing? Right? $315. I saved him $6,000 in closing costs, right? Because he took a rate, but the lender wasn't giving any closing costs, right? The total out of pocket was 19 grand for him on a $315 purchase. My out of pocket was 13,000. I was able to save him 6,000 bucks. Every scenario is different, right? That is the caution, right? Every scenario is different. But the best way to find out is to ask, get a second opinion. And every Friday, if you need us to look at it sooner or later, you know how to get a hold of us. You can call us or email us, right? But if on Fridays, if you have a loan estimate, you want us to beat it, we'll beat it for you, okay? As long as we get to use a scenario, we redact all the information to let other people know what we're beating, all right? And so other people know where rates are really at today, all right, guys? So don't forget to check that out on Friday on Instagram. All right, guys, enjoy the night. We want to end all our live stream with our attitude is gratitude. Without you, there would be no us. So thank you guys so much. Enjoy the night. Again, thank you so much for watching our show. If you have any challenges or concerns regarding what's a mortgage, call me 714-332-2526.